We're going to continue where we left off. Last, we looked at the overloan protection rider, which ensures our policy stays in force so we don't accidentally overloan the policy. This is a rider that should really never be used for managing the policy properly and playing honest banker with ourselves. Next up is the paid up additions rider, and there's no way we can go into all the details. We would have to go into some case design, but this is one of the riders that is used to optimize the cash value accumulation for infinite banking. There are three different components: 2-year premium, typically with an infinite banking style policy, base premium, term rider, and the paid up additions rider. And in my case design series, I'm going to go into some more details. I'll try to stay out of the weeds here. Of the $25,000 premium, $13,000 is going into the paid up additions rider. What is a paid up additions? Well, paid up additions is like stacking a miniature, fully paid up permanent life insurance policy onto your existing policy. Why would you want to do that? First of all, there's additional flexibility. So your base premium needs to be paid every year to keep the policy in force, but paying into the paid up additions rider is optional. There's some flexibility, not unlimited flexibility. This is an important nuance that oftentimes agents and customers don't understand, is that every carrier has different rules on how flexible their paid up additions rider is. There's never unlimited flexibility, but it allows you to pay into a range of premiums. So if we wanted to not pay this full $25,000 premium some years, we could drop less from the paid up additions rider. Remember that cash value is the net present value of that future death benefit, discounted for future premium payments. So cash value, if you have an all-base policy, grows very slowly in the early years. In fact, it would be zero for the first 2 years because you have so many future premium payments that are due. But a paid up policy has no future premium payments due. Therefore, we don't discount the death benefit when we're doing the cash value calculation. And if you don't understand what I'm saying, that's perfectly fine. Don't lose sleep over it. It's just a little bit of technicalities, but the upshot is the paid up additions rider is what drives your cash value growth in the early years. Over the life of the policy, the base premium really drives your cash value growth. But in the early years, the paid up additions rider gives you a shot in the arm of cash value. And this is one of the reasons why your infinite banking style policies, you'll see significant amounts of cash value, even in the early years. Most of that, if not all of that, is coming from the paid up additions rider. The paid up additions rider has some flexibility in terms of how much you pay into it and when you pay into it. And it is what drives your cash value in the early years. There's lots of different ways you can structure it. In this example, we are paying the paid up additions rider for 30 years, and then the rider falls off the policy by design. There can be different premium paying periods. Notice there's minimums and maximums. We can choose the length of time, etc. This version of the paid up additions rider is different. There are two different ones for this particular carrier. I'm not going to get into the nuances of how those are different. In the paid up additions rider, the maximum we can pay in every year is $13,000. We could pay zero. And just to go a little deeper into the flexibility, you do need to understand the flexibility of the paid up additions rider. That's important, especially if you're doing an infinite banking style policy. Because yes, there is flexibility, but not unlimited flexibility. And what happens if you don't pay the premium? As an example, with some carriers, if you pay less than the full amount into your paid up additions rider in any given year, you permanently reduce your ability to pay that full amount in the future years. With Penn Mutual, you have a relatively flexible paid up additions rider and what's called a catch-up provision. So if I pay zero into the paid up additions rider 1 year, I can pay up to double the next year to make up for what I missed in the previous year, but no further than that. For Penn Mutual, you have to pay something into the paid up additions rider at least once every 5 years in order to keep that rider in force. So if you paid nothing into it for 5 straight years, then that rider would fall off the policy and you would need to go through underwriting to get that rider added back. So that's actually a lot of flexibility that most carriers do not offer. So this is one of those important things that many customers are not aware of when you're just looking at an illustration, you're looking at numbers on the page. One of the things that will not be obvious, will not be apparent at all, is how flexible is the paid up additions rider. So if I'm putting in a large amount of money into paid up additions in order to get me a large amount of flexibility, what happens if I don't pay anything into that paid up additions rider in 1 year, or if I pay a small amount? In many cases, it dramatically impacts the performance of the policy. I won't go into too many details, but that's the paid up additions rider. It's what gives you the cash value in the early years. It gives you extra flexibility. There's lots of things it does for you, but always understand each element of the whole life insurance policy works in coordination with the others, not in isolation. Some people will say that, well, the paid up additions rider premium goes to cash value and the base premium rider goes to death benefit. No, that is false. All of these riders are purchasing death benefit, and we blend them to get the optimal mix to give us the best performance. And when I say performance, that depends on what you're trying to accomplish with the policy. None of these riders work in isolation. There is no such thing as premium going directly to cash value. That is not possible. Cash value derives from death benefit. So if you want more cash value, you have to get more death benefit. The only way to purchase cash value is to purchase death benefit, which then grows cash value. So 0 of your premium dollars, any policy, go to cash value. They always go to purchasing death benefit in one form or fashion. And then how the cash value is derived from that death benefit depends on how we structure it. So these are important nuances. Don't let someone tell you that you pay into a paid up additions rider, that money is going directly to cash value. No, it's purchasing paid up additions, which is paid up additional insurance, meaning paid up death benefit. That's what it's purchasing, death benefit, which then leads to cash value. And because it's a fully paid up death benefit with paid up additions, the cash value grows faster initially. But over the long run, the base premium gives you most of the cash value. This is the premium breakdown. So if you look at my case design series, we look at how these 3 elements play together. So there are 3 elements. There's more than 3 listed here, but there are 3 primary elements: the base premium, the term rider, and the paid up additions rider. So these 3 riders here don't really impact the performance of the policy, and there's no out-of-pocket charge for them. You notice if you look at the premiums associated with the accelerated death benefit, chronic illness, and overload protection rider, we're not paying any premiums for them. They're all included in the policy at no out-of-pocket cost, and they don't impact the performance of the policy. We've gone over how they work. They are some really great added protections, but they don't really impact the performance of the policy. I'm trying to stay out of the weeds of case design, but suffice to say, with your typical infinite banking style policy, you're going to have some combination of base premium, term rider, and paid up additions rider. And those 3 components working together and blended together are what makes the most efficient contract from a cash value accumulation standpoint. And none of those 3 elements work in isolation. They all work together. Base premium is your foundation. That's the most important and the only essential element of the contract. The term rider is like scaffolding. It's a temporary structure, because term is always temporary, that allows us to build higher than we otherwise might build. So that's scaffolding. And then paid up additions is everything else, all the brick and mortar that fills in everything else. Again, not going to go too deep into case design, but those are the elements. You can see how the premiums break down. We're paying the premium annually in this example, but you could pay the premium on different modes. You could pay it monthly. There's a small discount for paying it annually. It's totally up to you. About $7,200 going into the base premium, about $4,600 going into the term rider. This is a blended PUA rider. Over time, this $4,600 actually will be going to purchase paid up additions, not term, over the long run. And then $13,000 into the paid up additions rider. This premium amount, this $13,000, is optional. So that's the flexibility. So you could drop down and pay just the target premium. The target premium is the base plus the term rider. You could pay just the target premium of about $12,000 and not pay the paid up additions rider in any given year. So you have some flexibility there. Now, you would not be able to make up for the missed premium payment on an unlimited basis. As I said before, there's a catch-up provision where you can make up for the previous year's payment only. There's not unlimited flexibility. Underwriting class, in this example, preferred plus non-tobacco. This is based on your health. John Smith is very healthy, so he was lucky enough to get the best rating, preferred plus non-tobacco. Parenthetically, this is one of the reasons why I like convertible term. If you're super healthy right now, why not lock in your rating with a convertible term policy? And then you have the guaranteed right to convert that to whole life insurance without underwriting at some point in the future. So no matter what happens to your health, you're locked in at that ideal rating. So lock that in today. Dividends, we've talked about before. Dividends are paid. They're not guaranteed. They're based on a few things: the company's claim, expense, and investment return experience, basically based on the profitability of the company. The dividend option is paid up additions. Notice it says initial because you could actually change this collection. With my clients, there's really never a reason to do anything other than purchase paid up additions with that dividend. That is how you reinvest those dividends in the policy. And I'm putting reinvest in quotes. This is how you get compound interest. So the dividend is being used to purchase paid up additions, but you can see here what your options are for the dividend. So you have options. We're using the dividend to purchase paid up additions, which is pretty much always what I recommend. But you could use the dividends to pay premiums. You could have the dividend going directly to paying premiums. You could have the dividends paid to you in cash. The problem is it will become taxable income, but you could do that. You could simply accumulate those dividends and earn interest. You could use it to purchase 1-year term insurance, and you could use them to repay loans. But generally, we're purchasing paid up additions and all these other options. There's a better way to do those things. If for some reason you wanted to use the cash value to pay premiums, in my opinion, there's better ways to do it than using the dividend. You can take out a policy loan as an example and use the cash value in the policy to pay premiums rather than having the dividend go directly to pay the premium. Policy loans. This is a really important contractual right. It's important to understand a policy loan is a unique credit instrument. There's nothing else like it in the financial world. So people will talk about purchasing an asset like a house or having money in some securities account and then borrowing against it. You can do that, and there could be reasons for that. That could be advantageous. But there are always disadvantages to those versus a policy loan because you have to go to a third-party lender and there are going to be repayment terms. There are two options for accessing your cash value. Policy loan, you can take a policy loan against the policy. Why is that language so important? Because when we borrow against the policy, we do not interrupt any of the dividend and interest we're earning in the policy. But if I have $100,000 of cash value in the policy and I take out a $50,000 policy loan against the policy, my full $100,000 principal balance keeps earning for me. That's very powerful. All of the money keeps earning for me, no matter how much I'm using. That's very powerful. Loans will bear interest at an adjustable loan rate set by Penn Mutual as of the first day of each calendar year. Policy loans do charge interest. They accrue interest. The loan rate tends to follow interest rate in the market. They tend to be competitive. Loan interest is due and payable at the end of each policy year. If the loan interest is not paid when due, it will be added to the loan balance. An unpaid loan balance may cause the policy to lapse. The current loan interest rate is 5.3%. Taking out a policy loan is a contractually guaranteed right. There is no credit check. It is a right and you can take it anytime you want. There are no repayment terms. When I borrow against my policy, I am not required to make any repayments whatsoever. That's really important. I am now my own banker. I am fully in control. I took out a loan from my own private bank to myself, and I decide what, if any, the repayment terms are. That's what makes this so unique. There's no credit risk here, and I have full control. There is loan interest that's charged. In this case, 5.3% simple interest. And if I don't pay that interest each year, it gets added to the loan balance. So it's amortized or compounded annually. Generally, I recommend to my clients to at least pay the interest on those loans every year as a matter of discipline. You want to play honest banker with yourself. You want to repay loans, but it is not required. And there are scenarios where you would strategically not repay the policy loans. But generally speaking, if you're going to be your own banker, you want your bank to be profitable, which means you want those loans to perform. Why do policy loans have no repayment terms? Well, first of all, what you're borrowing against is a cash asset that's guaranteed to go up in value every year. The collateral is guaranteed. The insurance company is not worried about it. And it's no problem to the insurance company to repossess your collateral because they already have it. It's their insurance policy that they themselves are guaranteeing. Secondly, there's a death benefit on the policy. So if you die with policy loans outstanding, which if you're doing infinite banking, you probably will have some amount of policy loans outstanding when you die, then they're simply subtracted from your death benefit. And that's how the insurance company repays themselves. So if you have $1 million death benefit and you die with $100,000 of policy loans outstanding, the insurance company takes your $1 million death benefit, they subtract the $100,000 you owe them, and your heirs get $900,000. Very simple. So the insurance company is making you a loan on which they know it's mathematically impossible for you to default. They know they will be made whole one way or another. So from their perspective, it's the safest investment they can make. And the policy loan feature is really the key feature that enables us to become our own banker. We don't need any bank's permission to take out this loan, and there are no repayment terms. Let me say that one more time. We don't need any bank's permission to take out this loan, and there are no repayment terms on the loan. You can also surrender cash. So in terms of accessing your cash value, you can take out a policy loan and borrow against your policy, which is generally what we recommend because we don't want to interrupt the compound interest we're earning in the policy. However, if you wanted to just straight up withdraw cash, you can do that. It's called a partial surrender. We're not surrendering the whole policy here, which that I would certainly not recommend. You can do that. You can surrender the whole policy and get all of your cash value. But you can also do a partial surrender where you're keeping the policy in force, but you're just withdrawing some of the cash. And that's what this surrender option here is. Non-forfeiture options. These are really important. So if your policy is about to lapse, there are non-forfeiture options where you can get something back. So obviously, if you simply surrender the policy, you receive the net cash value. Whatever cash value is in the policy is paid out. However, you could also do various things. You can do what's called extended term insurance. So what you're doing is you're exchanging your whole life insurance policy for a rough equivalent term life insurance policy. The extended term insurance amount is equal to the base face amount plus any paid up additions and dividend credits, minus any outstanding policy loans. Term insurance will continue for the period provided by the net cash value when applied as a net single premium with detained age. So basically, you're converting your whole life insurance policy into a term life insurance policy. How long that term lasts just depends on how much cash value you had in the policy to pay for those premiums. So it allows you to keep that death benefit in force, at least for a few years, as a term policy. That's one option if you wanted to surrender the policy. Another is reduced paid up. This is a great one. If I do not want to pay any more premiums in the policy, I can take a reduced paid up. So what happens is there's a one-time reduction in the death benefit, but no reduction in the cash value. My policy is now fully paid up and no future premiums are due. If you have a whole life insurance policy and you hate it and you want nothing to do with it and you don't want to pay any more premiums into it, you do not have to surrender the policy. You can keep the policy in force and not pay any more premiums. You can get the best of both worlds. This is a contractually guaranteed right. So instead of surrendering the policy, why don't you just take a reduced paid up? So my $1 million death benefit now becomes an $800,000 death benefit. The policy will stay in force for the rest of my life. I still have access to all the cash value and I'm still receiving dividends and interest. So my cash value and my death benefit will start going up immediately after taking that reduced paid up. So this is a great option that I think anyone who's considering surrendering a policy should be aware of. You should be aware of all of these non-forfeiture options. If you're talking to someone who hates whole life insurance and you agree with them and you want to get rid of the policy, at least understand you have options. You don't have to get rid of the policy if you want to stop paying premiums and still get access to your cash value. You can take a reduced paid up. And then it talked about how a policy loan would be addressed. A policy loan would be extinguished. There's some details I won't get into. And now we get into some of the MET test. And this is probably a good place to put a pin into it, but we'll get into some of the tax information and the 7-pay premium. We have to design the policy in such a way that it stays tax-free in order to meet the IRS rules. And this is going to go into some details around how those are calculated. And that's a lot of the art and the science that goes into case design, is designing a policy that has maximum cash value accumulation while still staying within IRS guidelines to keep everything tax-free. But that we'll address next time. Talk soon. Bye-bye.